Reclaims Global is up over 50% in the last year. If you have been watching from the sidelines, you're probably asking, is there more upside or did I just miss the boat? BCA just forecast a $53 billion construction boom for 2026. In a gold rush, you want to own the picks and shovels, and Reclaims owns the fleet that move the earth and reclaim the waste before any building can take place. But their latest $38.8 million pivot into property has added a layer of debt to a previously debt-free balance sheet. Can the momentum continue, or is this acquisition the weight that drags the rally down? Before we get into the math, let's break down the business model. Reclaims Global is a subcontractor that operates waste management services in 3 areas. First, the excavation, which involves clearing of land, tearing down structures, and preparing sites for redevelopment. This generates a lot of waste. So what do contractors do? They hire Reclaims Global to collect it. Reclaims Global then use their own mobile crushers and turn it into recycled concrete aggregates, RCA, typically used for foundations and roads, and production of ready-mix concrete. Finally, there is the logistics and machinery leasing, moving raw materials around the island and providing heavy equipment to contractors. In sum, their business model is to get paid to generate waste, get paid again to remove waste, or move materials around sites, and finally get paid again to sell that recycled material back for roads and foundations. The catch, of course, is that with more excavation, there could be more supply of recycled RCA available, which may depress their selling prices. But overall, it's a model that helps Reclaim Global to make money at each stage of the prep process before construction starts. However, a lot of people look at first half 2026 report and saw a red flag. Net profit dipped 14.5% despite revenue being up. The culprit? A 51.7% surge in employee cost. This could certainly imply that costs are escalating, but because Reclaims Global uses percentage of completion method for revenue recognition, an increase in hiring costs could also mean that they're in the midst of a big project due for revenue recognition in later periods. I would actually check with management to find out more. Beyond the current infrastructure boom, Singapore's $100 billion coastal protection plan, which will span the next 50 to 100 years, is also a strong tailwind. You cannot build seawalls or dikes without massive land stabilization and earthworks. Unlike previous booms and bursts of construction demand, Reclaims could see long-term sustainable demand growth, which can drive a re-rating of its stock. What complicates the potential for further rally though is its recent $38.8 million acquisition of a freehold building near Farrer Park MRT station. With a mix of cash and bank borrowings to fund the acquisition, this single deal is worth more than 50% of their entire market cap at $68 million recently. While the headline purchase price is $38.8 million, the total investment to get the keys is higher. Some of the costs we have to take into account would be the nomination fee costing $1.5 million, buyer's stamp duty (BSD), which would cost around $1.94 million based on a 5% marginal rate for amounts above $1.5 million, and redevelopment could probably cost another $7 to $10 million, bringing the total project cost closer to $50 million. With current low interest rates, leveraging to diversify into stable recurring rental yield sounds good. But this move will likely squeeze their net profit margin for the next 2 to 3 years unless revenue significantly expands. Success rests entirely on whether their core excavation cash flow can bankroll this redevelopment and that the macroeconomy remains largely stable. While current operating cash flows seem sufficient for making interest payments on top of existing capex, the margin for error has shrunk. So more upside? Analysts say yes, with a 56 cents target. For some, the draw is the $100 billion coastal protection plan tailwind and gaining exposure to Singapore's commercial property. For others, the new debt creates a risk profile that requires a lot more caution. Success here really hinges on management's ability to navigate this diversification. And that's it for my research on Reclaims Global. Are there other infrastructure stocks that you are researching? Share them in the comments below. This is the first in our series on the Singapore infrastructure supercycle. Hit subscribe so you don't miss our next brief. I'm Singaporean and I'll see you in the next video.